So last class I had started this discussion on the assets and liabilities, and one of my primary motivation to introduce all this is I want to make you guys understand the financial statements of companies. And financial statements are of two major types that we will see in this course, but they provide a very important information about overall health, financial health of a particular company. These indicators are if reported properly, right? But before we go into all those things, first was a basic understanding of what are assets and what are liabilities. And assets we most covered. Essentially, assets are something that company owns in order to generate business or revenues. And we have seen multiple type of assets classification, fixed assets versus current assets, the 1 year period being the distinction. You also have the concept called the liquidity of asset, which is how quickly they can convert into cash. So cash is the most liquid and least liquid is like a long-term property or kind of a thing. That could be also somewhat similar to the fixed asset versus current asset concept, right? And we have also seen fixed asset could be also tangible and intangible form. Tangible is something which is physical, you can touch it, feel it. Intangible is more intellectual in nature and things like that. At the same time, I also gave you an understanding of what financial assets and non-financial assets are. Like these are all different type of classification. Depending upon business, your reporting standards might change, but more or less this is how typically the financial statements of companies are reported, and we'll look into those examples starting today. But before that, there's another concept which is the liability side. So as we already talked about it, liability is something that the company owes in a way that it has to pay it back in some form or the other. It could be that it owes to the owners of the company, which is like the initial stakeholders, initial shareholders of the company. It could be the shareholders themselves, because owners are different compared to shareholders. Owners could be who started the company, but shareholders could be now the company is publicly traded and things like that. So that could be shareholders. Also, whatever the financial institutions, if you have borrowed any loans, any mortgages, anything, so that's part of something that you need to settle over time, right? So you need to settle liabilities by transferring some of your economic benefits. If you're generating profits, by repaying some of that profit to these, you need to settle that, or some sort of money, goods and services. These are the kind of things there, right? So example may include loans, mortgages, account payable. Account payable for us is something that you need to pay. Account receivable was, which we have not received from the client, but account payable is something that you need to pay to your vendors or suppliers. Deferred revenues can sometimes be liabilities. I talked about that sometime the revenue, the moment you recognize the revenue is going to occur, you start recognizing it in your asset side. But sometime there could be like recall of your sales and goods and things like that. So that part becomes the deferred revenue, and that goes into the liability side of it also. For example, a restaurant owner purchases groceries for use from a vendor, but payment is not made immediately. So vendor sends an invoice for the purchase. Both the delivery and the payment become easier, right? This is the pretty standard system that we use. Credit is like very essential part of doing business. But in this case, that invoice is a liability for you because you need to pay that back as a business, right? So for the restaurant owner, the groceries that you received are part of your assets, right? Because you are going to use those groceries to make food and sell them. So it is part of your revenue generating stream. So it is asset, but the invoice is a liability. You need to pay back that invoice amount. For the vendor, the cash to be received is an asset. What is the equivalent liability for the vendor in this case? Can you just guess? In a simple transaction where vendor is supplying some grocery to a restaurant owner, for the restaurant owner, the groceries are asset, but the invoice which the restaurant person has not paid is a liability, right? But for the vendor who supplied the groceries, this invoice is an asset because he or she is supposed to receive that money, so it's an asset. Is there any liability on the vendor? So yeah, we'll look into this. This is a slightly tricky transaction, but essentially Asset can be plus minus also. So there could be like asset can reduce the size. Instead of calling it as a liability, now there is a change in the stock of groceries that the vendor owns, right? So that's its reduction in asset prices. Therefore, the total still remains same. The net assets and net liabilities are still same for the vendor, but it's not a liability per se. It is an invoices, it's an asset, but its lack of reduction in the stock of its own groceries is something which is compensating that new cash form, right? So we'll look into all these examples into more details, but yeah, just to give you an idea. Liabilities are also same classification. There are two types: long-term liabilities and current liabilities. We don't call them fixed liabilities, we call them long-term liabilities, but the distinction is same. It's the 1 year period. If you are certain that you are going to pay some of these liabilities within the next 1 year, it comes onto your current liabilities, short-term account payable, taxes payable, whatever the small expenses are there. But the long-term liability is something that you need to repay in a longer period longer than 1 year. So these could be bonds, loans and mortgages, right? And that benchmark is still 1 year to classify whether it has fixed asset or current asset versus long-term liabilities versus current liabilities. Okay, this is understandable? All right. So just to give you an example, current liabilities are usually expected to be paid in cash within the year that they are due, and long-term liabilities on the other hand are expected to be paid from assets derived from future earnings. So essentially long-term liabilities you are going to pay over the year. So you are going to keep on earning business, making money, and essentially you will use that money to pay some of these liabilities. Example could be a company takes a mortgage payable over 20 years. Right? Mortgage is essentially kind of a loan against some sort of a property as a collateral or something. This is a long-term liability because it is 20 years. The yearly installment of that long-term liability is going to be showed in your short-term, in your 1 year period. So that's part of your short-term liability. But the rest of the loan which you are not going to repay in this financial year is called long-term liability. Okay, clear? These examples are simple enough to follow. There are also linkages between assets and liabilities. In principle, in the current financial system that we follow, or the kind of notation that we follow, at any point of time for a company, the sum of all the assets have to be equal to sum of all liabilities. Is the spelling correct? I have no idea. But essentially, the sum of the assets has to be always and always equal to sum of liabilities. We will see how sometimes this creates confusion. We will see those examples in detail. But this is the modern or the most recent, and this is quite commonly acceptable. What happens is there is a specific term that need to be defined here, and that is something called owner's equity. What is an example of owner's equity? Suppose you want to start a business, right? So to starting the business, you need to put your own money, right? Let's say you took a loan of, or whatever, 1 lakh rupee, you as a owner, and you put that into your company's account, not your personal, or it could be your personal saving or whatever, but now it is in company's account. So the company, this 1 lakh rupee is shown in what? Liabilities or assets? Can you guess? Some idea? Asset is there for company because company has gotten 1 lakh rupees in cash. But company also show it in terms of the liability in a way that this is the money they have to return to the owner sometime in future. Right? Owner is starting the business. Typically, the business is done in order to generate profit. Right? So, company as a entity is neutral in that sense. It cannot generate, like, it cannot keep on hoarding money. Ultimately, it needs to distribute to its original stakeholders or some other investors. So, they also show this money as the liability. So, the total sum of assets and liabilities are always equal. But in the old kind of a system, this part, the equity amount that originally the owners invested, was not shown as a liability. So therefore, the net difference between the assets and liability was equal to the amount of money that owners had put into the business. And this is slightly tricky concept to understand in a way that why owners' investment is shown as a liability. It is a liability to the company because company ultimately aims to pay back to the owners. Right? That's the main goal of company to be established in the first place. Yes, whatever money they have put inside the business in terms of maybe buying some land or maybe actually putting cash, all that company will still show it in assets, but the amount that it has to pay back to the owners will be shown as liability side of it. So in this kind of a notation, you are always meeting this requirement, which is the sum of asset always have to equal to sum of liabilities. Right? We'll look at these examples more, but essentially this is the important part. Okay. So, but yeah, just to get you an idea that in the old convention, we used to use this something called owner's equity. I'll also explain you more examples as we move forward. There's also sometimes confusion in terms of expenses versus liabilities. Right? Liability is easy to understand in a way that something that you are owing, as a business you own. So you would automatically assume that whatever expenses are occurring is also part of the liability. Not always true. So we will again look into example, but essentially they are different in definition. Fundamentally they are different entities. They are related, but they are fundamentally different entities in a way that expenses are the cost which a company incurs for its operation, or in other words, to generate revenue. In order to generate 10 rupees, how much cost does it require for you to generate that 10 rupees of revenue? That's the operating expenses kind of definition. But liabilities are obligations and the debts which a company owes to others and can be seen as a responsibility. So while they are related, while they affect each other, they are different concept. Liability is something that you need to pay back either today or later. Expenses is something that you have already incurred in terms of cost, which you need to generate the revenue for, right? This will become clearer as we will look at more example. Expenses are recorded on the main difference between them is that these belongs to two different type of financial statements of a company. Every company typically makes two financial statements. One is a income and loss or a profit and loss statement. You might have heard this term commonly, P&L. When you start investing in stocks, typically you get this P&L statements, which is essentially your profit and loss statements. Profit and loss statement have all these values of how much expenses occurred and all these things. Some entry, the net balance of somehow this, I will also show examples, finally goes to something called your balance sheets. So these are the two main types of financial statement that a company typically produces and makes available this information for public consumption, depending upon whether they are a private holding company or, but anyhow, to the government tax authority, they need to declare these numbers. These are, one is the profit and loss statement and one is the balance sheet. And what is the main difference between them? Profit and loss statement is typically made for a duration. For example, financial year ending March 31st, 2023. So the profit and loss happens for a 1 year before March 31st, 2023. Assets and liabilities, which is the balance sheet, is a snapshot of a statement up to that point. So balance sheet is typically balance sheet on 31st March 2023. This will have effect of all the past decision that company might have taken. But the P&L statement or the profit and loss statement is typically for whatever the duration is clearly specified. That these many transactions that happened between this duration are recorded in P&L. Over the time, you transfer the P&L transactions also to balance sheet to give you a net impact at any point of time. Right? This is a fundamental difference. So While they are related, expenses and liabilities are related. Expenses can result into liabilities, and we will see those examples later. But essentially, these are different entities. They are belong to different financial statements of company. One belongs to the profit and loss statement. One belongs to the balance sheet. Profit and loss is typically for a duration. Balance sheet is till that point of time, or it's kind of a snapshot, as we call. If you take a picture of company's financial health today, we will call this is the balance sheet on this date. This is the balance sheet on this date, like that. Okay. So balance sheet is essentially the net accumulated effect of all several P&L of different durations that are happening. That is visible in your balance sheet account. Okay. It will become more clearer, but I want you to understand that expenses and liabilities are inherently different things, related but inherently different things. Okay. At the moment, any question here? We'll look at more examples for sure. Cool? Alright. So, the liabilities go to the balance sheet and used towards the calculation of equity net worth, which I will show you again. Essentially, the total assets minus total liabilities, essentially the money that you have to distribute to your stakeholders. That's the equity, as I already told you. Okay. Time reference, the same point that I mentioned. So, asset and liabilities are seen at a point of time. Whenever you see balance sheet, the first question that you will always ask or see, when was this balance sheet made? This balance sheet on this date, this balance sheet on this date. But for a profit and loss statement, you will always see profit and loss statement for the duration of so and so at this date or on this date, kind of a thing. So you need to know exactly where the duration for the profit and loss, and for balance sheet, when exactly was this balance sheet made. Okay. And the composition of assets and liabilities can actually change over time. Like the current assets can become fixed assets can become current assets, and vice versa. Liabilities can also change to a certain extent. Typically, liabilities do not change easily. Assets are called convertible in a way that one asset can be converted into other form of asset. For example, you as a company, if you hold 100 rupees today and you buy like 20 rupees raw material, so your total asset is still 100 rupees. Originally, it was all in 100 rupees cash. Now you have 80 rupees cash and 20 rupees worth of raw material. So asset can change the form. Liabilities are typically, they cannot change the form like that. You need to repay them and then they accumulate over time. We will see all those concepts also see. So this is also called a principle of convertibility, in a way that assets can keep change their format over time. Liabilities are more or less static, but they also change. We'll see, but they do not change form from each other. Like one form of liability does not convert to other form of liability typically. That we will see. In some cases it can. I am contradicting myself, I know, but for simple understanding, this is the statement which I am going to make. Okay. So, whenever you are dealing about asset and liability, you need to define at what point of time in company's life or on what date you are looking about these statements. Okay. I'll give you an example of convertibility. So assets are convertible in nature. We can convert one type of asset into another with changes in value and liquidity. For example, at any point of time, you as a company could have 5 acres of land, 5 lakhs in cash and 2 lakhs worth of shares that you might have bought as a company to invest. Later on, this could convert to 10 lakh rupees worth of shares. Maybe you sold the land and you bought shares with that money. All of these things can happen. Right? The value of shares and land changes with time, and therefore the value of assets is also not constant. The share as an asset will have a market price to it, so accordingly your asset will keep on changing. Similarly, your land value also changes. So 5 acres of land is not the same as it was, like it's not same today as it was 5 years ago. That value change, appreciate, depreciate, whatever, and that need to be properly reflected in your balance sheets as well. Typically, balance sheets do not have such quantities mentioned. They always have a money equivalent mentioned. You never will have like 100 units of inventory. You will have amount worth of inventory in your assets, in your books. Okay. Liabilities are not convertible in the conventional methods of creating balance sheet, but in modern world, we are also changing these norms, and you will find something called a I don't know, again, if you follow Shark Tank, this is a common term that you will hear, something called convertible note and all. I'm not going to too much detail about it, but essentially it's convertible note deals with the equity percentage. How much my money is going to be worth, what percentage of your company can change over time depending upon how the business does and so on, but will not go into all details. But essentially, assets are convertible. In the conventional sense, liabilities are not convertible. Okay. Yeah. So not only the balance sheet, but essentially the two types of financial statements that I introduced, profit and loss statements and balance sheet. Let me give you an example. And so let's look at this. Profit and loss account statement, also sometimes known as income and expenditure statement. This is again just the same term. This is statement of earnings and statement of operation, prepared typically at the end of a relevant period. It could be a quarterly reporting, so that you will say this is the income and expenditure statement of this quarter ended on this date, or financial year ended on this date. And this gives you information on whether your operations in that particular period of time were profitable or not. So this statement has an entirely different purpose. Balance sheet has a different way of looking at the numbers. Profit and loss statement just tells you whether in that quarter or whether in that reporting period you made more money than you spent on, kind of a thing. That's the kind of understanding this statement gives. In order to prepare profit and loss statement, typically you need to have information on all of these things. I'm not going into detail, but we will look through examples. You need to know the profit, you need to know the cost incurred, need to know income from any other sources that you might have had, interest if you short-term interest if you paid, outstanding expenses, all the information that we have seen that goes also profit and loss, and then later it gets also transferred to balance sheets. So this is an example of a profit and loss account for, again, pay attention, I'm clearly mentioning the time duration. For the year ended on 31st March 2018. So 1 year before this date, this is the profit and loss statement. Okay. Now typically this is taken from a real example. I am not going to disclose the company name because I have not taken it. I have taken it from NPTEL course, which is already being taught. So you can also take those lectures if you don't like my lectures. But essentially, you have here on a left side column, you typically have all the brief information about what these heads mean, like a very brief description. And this is also more or less standardized depending upon what kind of business you are in. This gets more or less standardized. You do not write like long details about things, very short description, which is still easy to understand. And then you report numbers which are of the current year, which is your 31st March 2018, year ending on that. But you typically also report numbers from some previous years. Could be previous 1 year, or you could also give previous 2 year, 3 year, 5 year, depending upon what your requirements are. That comparison gives the investors an idea compared to a year ago, how well or poor are you doing as a company, right? Is there any been market growth? Is there any growth? Is there any decline? Those kind of numbers are also easy to ascertain. So this information is typically available, right? And what happens is, these statements, again, you could go to n number of granularity, like you could end up making 1,000-line profit and loss statements, because as a company you are having so many transactions every time. But it all depends upon how consolidated you want these statements to look. So another way to make the statements consolidated is something called creating the information on schedules, right? So what we call is, for example, income from operations, and I mention this J as a schedule name. It means that the total income from operations is given here. That information is given here. If you want more information about how did this income come and what are the sources of that income, please look at the schedule J of the financial statements. In that, I will provide much more detailed information only about the income part. So that way you can delink. If somebody is really interested in only income, they can go and look into those schedules. But otherwise, as a consolidated form, you always get a information in a very quick manner. That's the idea, and that's how the accounting typically works, right? We will also look at more detailed examples. There are, yeah, it's a messy affair if you want to do it manually, but these days, of course, the computers make it easy to do. But essentially changing money, one transaction from different accounts here and there, there are known principles and known standards to do that, and that's the accounting definitions of you need to maintain. We'll not go right now, we will look at those examples later, but right now the information is schedules. Okay, so for this company, since we are talking about the P&L, first is of course the profit and loss. There has to be income related statement. So income from operations is in this year is 2,395 crores. Compared to the previous year, this is slightly higher. So you get an immediate idea whether your income actually increased or not, right? Company's share in profit loss of integrated joint ventures. So this particular company is clearly a part of a group of small company or a big company, like a conglomerate of companies. So they as a big group may be investing money here and there, and depending upon how much share this company holds out of the total pie, some of that benefits is getting transferred here. So it's shown in this company's books, right? So that's the profit that they have made. If it was loss, I would typically describe it in brackets right here, right? Other income, if you are somebody is interested, they can look at the schedule K. Otherwise, you know that, okay, this is compared to 2,394, this is like pennies. So I don't care, or you care, depending upon, you can go and check the information, right? So this is the idea about the income only. Expenditure, again, since we are talking about profit and loss accounts for the year ended on 31st March 2018, clearly defining the duration. In this case, the expenses are construction expenses. This happened to be 1,837 crores, right? If you want more information, go see Schedule L of this statement. Employees remuneration and welfare expenses is somewhere about 208 crores in that financial year. Compared to previous years, this is 131. So you know that there is quite a significant jump in this kind of a thing. If could be a concern, could be a good thing, maybe this is intentional, maybe this is not intentional. You can clearly look at the numbers immediately. Office and site established expenses, again higher than previous year, right? So the interest that you need to pay is also shown here. Again, this is little bit longer, therefore it's not coming all in one page, but typically these are long A4 or even longer statements that is easy to find. The total depreciation that has happened again is given to you on all its assets, it's given to you. So the total cost in that financial year becomes your L, M, N, O and the depreciation. We are doing at a company level. So depreciation actually gets subtracted from the total income, right? That's the kind of principle we have looked at. So this amount comes out to be 2,283 crores compared to 1897 a year ago, right? So profit before tax and exceptional item. What is exceptional? We'll look into that. But profit before tax is, this was your total income minus your total expenses. So this is the profit before tax, right? Easy, not a key problem. Sometimes there are exceptional item in a way that these are not recurring or regularly occurring kind of a transaction, but they could be significant. So therefore you might want to show them. So for example, in this particular case, this company is clearly a construction company, and often they deal with land development rights and things like that. So there is some additional money that they needed to pay for that was mentioned in the previous year, but there is no corresponding money in this year at least, right? So from your no, this is your transfer of development, right? So you have received this money, not you have paid this money, you have received this money. So your total profit before tax is this quantity plus whatever the value here, this is coming out to be. So because of now you know clearly that you also need to indicate this, right? If you just report this number directly, people will clearly see, hey, your profit has gone down. But now by this detailed information, you know that your profit before tax and except whatever the item, the regular thing, is higher than the last year. But the last year's total profit is higher because of this exceptional item. So that's not our regular business. In our regular business, we are still doing good. It's just that last year we had some unexpected higher income and we have clearly shown it. So you need to change the reporting a little bit in order to give a clearer picture to the investors also. Otherwise, if you just give this number, they will immediately question, hey, your profitability is going down. But the true picture is no, your profitability from your operations has not gone down. It's just that the development right related income you have not gotten and therefore you could do something about that, right? So you need to be careful in what you are reporting. There could be current taxation. There could be some taxation which the company did not pay from the previous year. Sometime it happens. Typically in taxation law, you can file income taxes or revise income taxes even for past 2 to 3 years. They give you a retrospective allow of change of your statements because sometimes the transactions are not ready by the time you are filling your income tax informations and all. So you can change your statements up to 2 to 3 years in the history. So accordingly, recalculation happens and all this money is also properly shown. So the profit before earlier year's tax is coming out to be this much money. Okay. So this development right clearly had a huge impact to play in this total number, but at least you get a clearer picture. Okay. Now, this profit 116, company can decide either to reinvest in the business or distribute some of this profit back to its shareholders, because a lot of people have invested money in the company. So per share you also expect some money to get back, or you might even want to pay to your original owners, like because owners have invested huge capital, so they are expecting some sort of a return. So if those kind of information is available, you will have redistribution of some of this 116.16 crores to the original investors. In this year, the information is not available. Otherwise, it is also shown as part of the P&L statements. How much dividend? Dividend is the amount that you receive per share and the number of shares that you have given in the public offering when the company goes an IPO. Those kind of numbers also are given over here. And that's in fact quite an important metric for a lot of people who are your future potential investors, because they look at it, okay, how much money is this company, how profitably are they being distributing, or how equally they have been distributing. Sometimes the company is generating money, but they are in the growth story. So they are investing everything in everything back in their own business, but they're not giving money to original investors. So that even they are growing, but you as an investor are not making any money through that company. So that's an information that is important for you also to understand. You can look at the previous year's examples, okay, how frequently this company has been paying dividends and all. So that information is also kept here, right? But not in this particular case. So this is ideally, if it would have been, this would have come here. And then that would of course reduce the total profits available for company to reinvest in its own business, because you have paid some of that money back to your investors or stakeholders. Alright, so this is called EPS, earning per share. Appropriation is payment to shareholders, essentially your profit sharing. What if there is a loss? Do you ask more money from shareholders? Yeah, share price has already gone down, but yeah, in that case, if you have raised more money from market, or somehow more people are still investing in you because they are still hopeful that in future you will generate money, that should be part of here also, because that's a net profit, net income that you have gotten in this particular financial year, right? So yeah, but typically that information is visible more easily in the balance sheet rather than the P&L statement. Okay. All right. Now, balance sheet, again, right, today I'm just showing you the examples, how to prepare everything. We will look into it in the next week. That's the main agenda. But balance sheet is a statement prepared to know the exact financial position of the business on the date of preparation. P&L statement is for duration. Balance sheet is for a specific date, right? What it typically has, it tells you status on a particular date. It tells you status of what a company owns. It tells you the status of what a company owes, and it tells you in order of their liquidity. Liquidity, we already looked at. How easy it is to convert some of the assets into cash is the form of liquidity, right? So, balance sheet have these main items. There's a liability, there's an asset. Typically, you do not have them in a like a one-to-one column, like two parallel columns going on, not like that. First, assets are reported, then liabilities are reported, and similar to what we saw in the P&L statement, they also show you year on year, like balance sheet on this date, a year ago, so that you also know how company has progressed over the years in terms of its assets and liabilities. But the order in which the assets and liabilities are reported from top to down is increasing order of liquidity. So the cash, the current assets are shown below. Fixed asset, the long-term assets are shown above. Similarly, the long-term liabilities are shown above and your current liabilities are shown below. The liquidity is increasing order. Why it is important? Again, it's a convention, and the convention everyone follows, because you clearly know, even if you as an investor you don't know what each of these items are, you can actually get some relative sense that how this particular asset's name is, how liquid it is or how liquid it is not, right? At least that information you will have. So this is a convention that everyone follows. The names can sometimes be confusing if it's like a chemical company and they're reporting like a really sophisticated piece of machinery on their assets. At least you know, depending upon where exactly it is positioned in the balance sheet, you will know whether it is easily liquidable or not kind of a liquidable kind of an asset, right? So that convention is everyone adheres to, and that's the idea. So let me show you examples. From the liability side we will start. So typically liabilities and loans, again we are looking at the balance sheet. So balance sheet is not for a duration, it is on a specific date. So balance sheet on 31st/3/2018, balance sheet on 31st/3/2017, just to give you a comparison, right? Got an idea? Now let's go on the liability side. So the first side is share capital, reserves and surplus. Share capital is the money that people have invested in you as a capital investment. And as I told you, in the new convention, this is shown in the liability side, because ultimately the owner's money, as a company, you need to pay it back, right? So you are showing that on the liability. Liability is something that company owes to other people. So company ultimately has a responsibility to pay it back to the original owners, and therefore that money is shown as liability side. Similarly, reserves and surplus, whatever money the company owed from previously, the profit and loss statement, suppose if they generated 141 rupees or whatever that crore rupees, ultimately the company has to, that profit belongs to shareholders. Finally the profit belongs to shareholders. Whenever the company terminates, then total profit they have to give it back to the shareholders. So therefore it is shown as part of their liabilities. But you know how much money is from the original and how much money is something that you have carrying forward in your surplus reserves and things like that. So you might be using this money to reinvest in your business, but ultimately you owe this money to the investors or the shareholders. So you also show this money as part of a liability. Okay. So the total shareholders funds is about 904 crores. Okay. If you want more information, the same convention of schedules is also there. If you want more information, go to schedule A, schedule B, and so on and so forth, right? Loans. Do you know what is secured loan and unsecured loan? So secured loan is taken something as a collateral. For example, you give a guarantee that if I don't pay the loan, you recover your money by doing this action. This could be in form of many things. For example, if you are taking the money for a project, the future cash flow of the project could be part of the secured. If you are not able to repay the loan, the bank will start operating this and try to recover the money. It could be a physical asset, that this warehouse we are putting at a mortgage, which is also in Hindi we call the word girvi. Essentially, that if we are not able to repay the loan, the bank is entitled to sell those assets and recover its money. So that's the secured loan. Unsecured loan is not backed by some sort of an asset. This is given more or less by the assessment of the bank on your company's capability to generate revenues and things like that. For example, when you go for a student loan, you don't have to necessarily put a house on girvi or a mortgage. They assume that, okay, you are going on a good college, so there is a good likelihood that you will get a job, and all that assessment once they have done, they will issue you a loan amount, right? Assuming that, yeah, this kind of a person graduating from this kind of a good university is likely to get such and such paying jobs, and therefore they will be able to repay our loan. So let's invest in them and let's make money on their growth, right? So that's the idea. But it is not backed by a physical asset that if you do not repay your student loan, we will take your families home, right? So it can happen. If the loan amount is really big, sometime it can happen. You need to have mortgages, but otherwise in simple loans, sometimes it doesn't work, right? So that's the unsecured loan part. Let me come to this. This is fine. Liability side of it is making sense. We have the long-term liability in terms of the original stakeholders funds that they have put, the loans that you have gotten. These are fixed assets. Gross block, this is essentially a detailed set of the inventory that the company holds and things like that. Again, you can have a schedule information on this, but there is some depreciation. Depreciation reduces the value of the asset. So an increase in depreciation amount is not necessarily an increase in liability. It is essentially a decrease in asset value, right? So that you need to properly reflect. So in this case, suppose the depreciation amount has been given to you. So the net block is essentially the gross block minus the depreciation amount. That's your total assets. Item awaiting completion or commissioning. This is kind of your inventory equivalent. This is you have started working it, making it, but it's still not completed or not finished goods. Right? For example, if you as a company are in a business of making mobile phones, some mobile phones you might have completed 40%. They're still part of your assets. You have not sold them, but you have the raw material and they have slightly changed than raw materials. So they are work in progress kind of a thing. They are also part of your assets because in future you will use them to earn money. So the total fixed assets is essentially this sum, and this investments is a this is the investment that you as a company hold. That's the information that has been given to you here. That is part of your assets, right? This is the income that you are getting from them. So we'll start from here. I will definitely share these slides. So just go through these slides till the end, and basically next couple of weeks we will be following more into how to read these statements, how to make these profit and loss statements as well as the balance sheets. Okay. All right.